lithium agreement is not in the interest of Ghana. That's my view. And if you all agree with me, then let us make a statement in support of the IEA to say that we do not think that this agreement is in the interest of Ghana, and that we need to relook at this matter. Let us tell whoever is signing this document, and I don't even want to condemn our MPs. We will caution them and advise them to do what is what? Right.
We cannot.
And to help us get a bit more into it, as we've started over the last couple of weeks, Bright Simmons is the honorary vice president of Imani Africa. He has been doing a lot of work in this particular space, and he understands especially how such agreements should play out. And he's joining us. Mr. Simmons, good morning. Thank you so much for joining us here on Key Point.
Good morning, Alfred. Thank you for having me.
Great. Now, let's start off with this. First off, this lithium that we have found as a country, why is it important in the scheme of things as we have in that we should not be treating it like any other mineral that we have found as a country?
So the way we see it is exactly the way you've put it. It's a potential game changer. So it requires imagination. We have to be more innovative. We have to have a certain innovative mindset as a country to handle the opportunity. And one of the challenges we have is that there's been a failure of imagination among the policy-making class. Lithium has been called the white gold because, this mineral was discovered 200 years ago. And when it was then discovered, its primary use was in medicine. So it was used to manage psychological conditions like mania, bipolar disorder, and things like that. Over time, it began to be apparent that it's very good for certain applications in ceramics. So we started to use it also in ceramics. What has made it different over the year, what is now different, compared to those years, decades ago, is that now, because of its lightweight nature and the fact that it's a very good conductor of electricity, is the most important, one of the most important minerals or metals that is used in car batteries. But I'm talking about electric car batteries, so not the batteries that you use in your combustion engine, the one that you use petrol, but these ones are the ones that you charge, these electric vehicles that are becoming all the rage. They are not yet as popular in Ghana, but in many parts of the world, they're becoming very popular. In recent times, maybe 70% or more of the cars sold in major Chinese cities have all been electric vehicles. Each one of those cars need a battery, and lithium is one of the most important metals in making these batteries. 85% going to 90%, all the lithium mined in the world today go into making car batteries for electric vehicles. On top of that, we expect, because of the transition towards more green energy, away from fossil fuels like petrol and gasoline and all of that, diesel and all of that, that transition means more electric vehicles, more usage of solar panels. Solar panels require batteries, electric vehicles require batteries, wind mills require batteries. The lithium is the metal that is used to create the batteries or to produce the batteries that go into all these applications. So because of that, there's an expectation that demand for the lithium will go through the roof. It will be the metal that will see the highest growth in demand in the next 25 years going forward. So what that means is, with increasing demand, will be increasing price and increasing value and increasing importance. So if you have that metal in your country, people want to do a deal with you to get access to it. That's what made this so exciting. It's important, though, that we bear in mind that to make the batteries, you don't only need a lithium. You need other things beyond the lithium, and you have to keep that in mind if you're going to be able to make batteries in your own country.
And that's some detail there. And
because indeed, some of the minerals that we need to make the batteries beyond the lithium, we also have in Ghana. We have some iron ore, we have some graphite, we have some mica, we have some other minerals that have already been discovered in Ghana and not being fully produced. They are similar to what we have with the lithium. Some foreign company has made a discovery like graphite in the north, And we have to now have a more strategic approach into what all of these minerals mean if ever we want to be part of this grand transition to green energy and to clean tech. So that is why lithium is so important.
Now, thank you. Now, with this background giving and why this lithium is so important and we cannot treat it like any other, Mr. Simmons, anytime the question about this deal with Bavaria BV Ghana Limited comes up, the minister and the Minerals Commission are quick to refer to what is in there for us. So they talk about royalty rate of 10% on the lithium and all associated minerals, which is the current one is 5% for the mining sector, corporate income tax of 35%, the freed carried interest of 13%, they say it's 10% for what we have now, and then also GET Fund 2.5%, and NHIL 2.5%, and Growth and Sustainability Levy 1%, and then the setting up of the Community Development Agreement Fund of 1%, and a few others that they have mentioned. So what exactly is wrong with this Bavaria BV Ghana Limited deal with the government of Ghana on this lithium fund? Let's get into it.
First, the challenge that we have with the way that the ministry and the ministerial commissions describe things is that they're not paying attention to the fact that this is a green mineral. And as I've tried to explain, the green mineral is a future mineral. All the other minerals we have are past minerals. So your gold, your oil, and the rest of it is old economy. Lithium, cobalt, nickel, map to the new economy. So you cannot use old benchmarks to try and get a grasp of it. So if you mention all the benefits that they say we are getting, but they are not paying attention to the fact that in the case of lithium, for instance, the capital expenditure to get it out of the ground and to derive value from it is much lower than, say, gold. Some companies in the country lose money on gold when the price tanks because it's so capital intensive and it's so highly traded that the pricing can be extremely, extremely problematic. Now, in the case of lithium, we know from the numbers that the company that is going to do the mine, Atlantic Lithium, has shown us that the capital expenditure is very low. They're going to spend less than $200 million for the entire operation over the lifetime of the mine. So they're not spending a lot of money because the way the processes that they have to go through to get the lithium in this early stage, where they are only doing dense media separation and doing flotation maybe much later on, it's not very intensive like deep shaft mining or things like that. So that's one point. The second point is that historically, we've gained more from minerals when we've negotiated with foreign investors than this particular instance. So they claim that that the deal that we've cut this time around is so favorable to the country, cannot be upheld by according to the historical record. The historical record is very clear. In the 70s, we had 55% control of our natural resources, our stake in all the mines were either that we own it outright, we own most of the gold mines outright, and then for the others, we had at least 55% in them. They would say, okay, but in the 70s, that was because there was the nationalization drive, so it's a different context. Well, that principle began before the nationalization drive, because in 69, the government negotiated 20% equity in Ashanti Gold with an option to buy an additional 20%. Even after we decided that because of mismanagement, state control and state management of minerals is not in our interest, we decided that in the late 80s after we went to the IMF and the World Bank. Even when we decided that, we still went into joint ventures. So we did a deal for the Konongo Mine project with Southern Cross Mining, for instance, where we got 30%. So all I'm trying to explain is that the historical record is in complete variance or at complete variance with what the minister and the ministerial commissions, obviously the minister is guided by the minerals commissions, from what the mineral commissions have been trying to push across. In simple terms, it's not true. We've had much higher share, higher stake in our mineral resources in the past, all the way through the 60s into the 80s. The issue was that we mismanaged those resources. We were not able to manage them well, which is why we have to rely more and more on foreign investors, in the foreign private sector investors. It doesn't mean though that we must continue to create conditions in which foreign investors get a better share all the time. We have the means to begin to improve our management capacity so that we can continue to increase the amount of share that we gain. So that is, in short, a response to the specific issue of whether or not the terms in the agreement are the best. So number one, you have to look at the economics of the project, and the economics of this project are that it's highly profitable because of the nature of the mining itself. Number two, you have to look at our history, not just last decade or last 2 decades, but the span of our history. And you recognize that the truth of the matter is that we used to get way more out of our minerals than we get today. We just mismanaged what we were getting. Number three, we have a situation where invariably there are specific challenges with the agreement, which some of us have raised and which on this call I hope for the opportunity to raise, and which the minister must avert his mind to. So rather than talking in general terms that this is good, why not tackle the specific challenges that we've raised about the deal?
I see. Now, so it's been underscored, as you indicated, that contrary to what the minister and the Minerals Commission makes the point, this is not in the best interest of us or as a country at this point, the current nature of the deal. But if you look at the specifics, as you were just talking about, the likes of, in fact, if I look at the write-up of investment lawyer Fuichikata and the former Minerals Commission chief Kofi Ansah, they attempt to simplify the calculation of how much we stand to gain as a country. So, for instance, they say that royalty plus levy equals 11% of, say, 100 Ghana cedis. If you look at the revenue, if you put it at 100 cedis, income tax of 24 cedis, 50 pesos, dividend of 6 cedis. These add up to 41 cedis, 50 pesos for government versus 39 cedis, 50 pesos for the investors, if you put the entire revenue to, say, 100 cedis for that matter. Now, looking at this, is this a certainty? And can this be the case in absolute terms based on the details as you know?
Yes, we're very happy that eminent voices like the ones that you mentioned, Mr. Chikata, Mr. Ansah, have decided to join the fray. This is really very welcome. We hope that other policy issues, other eminent voices also continue to do so. The numbers that they give are illustrative numbers. They are based on assumptions. So if the price was, if the revenue was 100, then in those circumstances, this is what you might get, etc., etc. The truth of the matter, though, is that all those assumptions depend on real market conditions. So, for instance, the amount of profit that might come out of it will be dependent on the costs. So it will be dependent on agreements that the company makes with its contractors. It will depend on its finance costs, how it raises money, for instance. How much, in fact, some of the revenue numbers are even tied to how much it decides to sell the output for, the spodumene concentrate, which is the main output that the mine in the beginning will begin to produce. The community development fund that they say they will create, they are responsible for creating it based on agreements they will sign with the community. We don't know the terms of those agreements. We don't know how much of that will actually go to the people in the end or how much will go to high salaries for people that they put in charge of that fund. We don't know any of this, right? So most of this is illustrative. And it's the same way that the IEA also did illustrative analysis to prove that we were losing money. So it depends on the assumptions you choose, because we are looking into the future. What we want to focus on are specific issues in the agreement where, to our mind, already there are problems. So for instance, how you calculate the royalties that the two eminent gentlemen mentioned is based on the price you get when you sell the product. But the truth of the matter is that the price in this agreement, in this context, that price is dictated by off-take agreements that the company has signed. So the company has decided to sell forward 50% to a company in the US called Piedmont, because Piedmont is giving its money, about $17 million, to do the exploration to get to this point where it's managed to get a lease from Ghana. Now, that $17 million investment presupposes that this company, Piedmont, will get a strategic pricing. Will get strategic pricing from them. The pricing will not be open market pricing. It will be based on the fact that they need Piedmont. So you have to discount the pricing in order for Piedmont to also take the risk of giving you this money upfront. So we are arguing that yes, they can do those things, but when it comes to how we calculate the revenue on which we charge royalties, there has to be some price discovery regime so that they don't end up doing these non-arm's length transactions where, because the other party is doing some other thing for them, they discount the price of the mineral significantly, and then it hits us because we only get a percentage of the sales. So if, for instance, they need money to do Ivory Coast, and Piedmont gives them money to do Ivory Coast, and because of that, they say discounts the price of the spot demand for us. In the current setup, we can only act when they need export permits, but by that time it's too late because those arrangements are already in place and you are locked into it. And unless you want to get zero, you have to approve the export to go ahead. Now the export goes ahead, the money that gets made, often many months later, you look at the numbers, you find out the royalties you are getting is very low. So we propose that there should be a minerals discovery, a pricing discovery, for instance, around the royalties. There are specific issues around equity where we get a certain stake in the mine. It's about 13%. We say, look, 13% may sound great if you are doing gold and other minerals where these are old economy commodities, and there isn't much room for margin for margin gaining. In this new green economy, some of these minerals are going to be such high demand, or there could be shifts in technology that are so abrupt that their value increases dramatically. In those circumstances, they may end up recovering their investment much earlier. In fact, already they expect that in 5 months, they will have recovered the cost of the actual capex, the capital expenditure, because it's so small. So all of these things cancel for one thing. We need to get more equity because it's a very different type of operation compared to the ones that we are used to, like gold, bauxite, and the rest. So we need to use something we call options in finance, which allows us the flexibility by giving us the right, but not the obligation, to acquire more of the local company that owns the asset when the economics improve dramatically. We also want to draw attention to the fact that even though lithium is looking so brilliant, there is a prospect that because there are competing technologies that do not use lithium, like sodium ion, like some selenium batteries that are coming up, and the fact that we are recycling a lot of old batteries to generate new lithium to use in new batteries, all of this will affect demand dramatically. And so we need to understand that when it comes to owning equity in the find, it's not all rosy, because the equity that the type where we have to also pay money to run the mine comes with risk. So you need to have situations where you have the option to exercise, not to offside, etc., which is exactly what MEF has done. It's not clear why the government is not doing it for the parts of the ownership that accrue to the state, as opposed to a subsidiary of the state, in this case, MEF. We know that pricing can be very volatile. Pricing has moved from $81,000 in November 2022 to just $16,500 in recent days. Now, what that tells us is that in the same way, it can also go up to 200,000. And in those circumstances, you want to create a variable royalty structure where the royalties change. So there's a fixed bottom, which is the 10%. But if the economics look so good beyond a certain point, then we can get more royalty. We should get more royalty. If you are making profits that are fantastic, then we need that kind of windfall arrangement. But we can't rely on windfall arrangements in general taxation, because that affects the entire sector. Or this could be a mineral per mineral issue, or at least a green mineral issue. So, and the fact of the matter is that we've done this in the past. In the past, we used to have a bottom, even for general minerals like gold and the rest, we used to have a bottom royalty, and then things are dramatically good for the company. We move on to having increase in our share of the revenues.
Now, based on what you have just shared with us and what you talk about, all the uncertainties in there, the Minerals Commission, and indeed the detail they gave about this particular deal, they put the value of this deal to a little over $1,000 per ton from what we saw earlier. Now, would you support the call for a mechanism to be inserted in the agreement such that if the economic gains change dramatically, which actually could happen, at least looking at the huge uncertainties in the lithium space, Ghana's revenue share and the equity holdings in there could also correspondingly increase, so that we're not going to be fixed to this amount in this deal when there's a probability that the value of lithium would go up?
Yes, as I've already explained, the idea of a variable royalty structure makes a lot of sense. You have a base minimum, a floor, and then when the economics transform or change dramatically, you adjust it. There's an automatic adjustment mechanism that increases it. So, for instance, just a year ago, spodumene concentrate, which is the main output from the mine that we are developing at Ewuya, or Atlantic Lithium is developing at Ewuya, was in excess of $8,000 in some places, ranging from $4,000 to $6,000 in others. Now it's above 1,000. So if there's a prospect that it can go back up to 8,000, or you move beyond even the current mineral that is being produced, which is the spodumene concentrate, and start to introduce more higher value chemical derivatives like lithium carbonate or hydroxide, then you are talking about a situation where the main output of the mine goes up to like $80,000, like it did last year, November, when lithium hydroxide and the like were selling for $80,000. So if you benchmark that price to the lithium oxide in our spodumene, you get a sense, because it's linearly correlated, you get a sense of how high this could have gone. So in short, we're saying that the economics can change dramatically because this is such a volatile space. You should have the flexibility to benefit more, and not just in the royalty terms. We're also saying that over time, the investors recover their money very quickly if the price goes up and stays up. Already, even at the current price and at the price that they use for their DFS, their feasibility study, that pricing was about $1,600. On that pricing, they get their money back from the plant that they are building to do the spodumene concentrate. They get their money back in 5 months. So there's no reason why an investor that gets their money back in 5 months and then in about 2 years will have fully recovered all other expenses, etc., and made enough profit, should continue to own 87%, right? Or in the case, assuming that we buy through MEF, should own 80%. There should be a way in which, as they recover their investment, we have the option to claw back some of the equity. So these are all creative options that we've suggested, and it doesn't really hurt for the parliament, now that they are going to be seized with this issue, to insist on these things. And maybe the government, even before it sends it to parliament, given all the feedback that is coming, should consider renegotiating the agreement before it sends it to parliament.
Now, I'm looking at the agreement right now, portions of it. A major aspect of this whole transaction, per my initial analysis, is the decision by Ghana to buy through the Minerals Income and Investment Fund more stake in Atlantic Lithium at a cost nearly twice the amount of money that the company's own backers initially invested in Ghana. I mean, does that raise any concerns for you?
Yes, because we get a sense of the strategic issues at play. This company, as you've rightly pointed out, had the cash flow issues. It doesn't really have cash flow because it's not at the stage where it produces anything anywhere in the world, right? It's a very early stage company. It's a startup. So it didn't have money to invest in Ghana. And what it did was it signed an agreement with an American company called Piedmont, which had some deals with Tesla to produce or to supply some inputs for Tesla's car batteries, the batteries that go into the EV. So this company had a source in North Carolina, in North America, and a source of lithium, I mean. But they were having a lot of regulatory issues with, some of the people that stay near the mine, where they wanted to do the mining, protesting, and insisting that it's going to pollute their waters and they will not allow the lithium to be mined. So when Ghana became an option, when the option to get lithium from Ghana became an option, this company put in about $17 million into Atlantic Lithium to allow Atlantic Lithium to do all the exploration and all the stuff that they've done to date and acquire the license. So now we realize that, there's some goodness there, and we want to also buy in at 32%. We want to buy at about $32.9 million, which is almost double what that company has invested. What we are arguing for is that the price to us because we are also a strategic and anchor investor, this company is still not getting money from all over the place, right? Because of where we stand in, we should also, and we will be negotiating for a long time before some others have also tried to come in, but we've been negotiating before them. We should by now have had the price just a little above what Piedmont got, because it's our lithium, and because we are also a strategic supporter, given all the conditions we're giving them. They've been in Ivory Coast for almost 6 years. They have not even progressed from application to getting a full pre-mining lease. So we've been very good to them, is what I'm trying to say. Given that we've been very good to them, and we've expedited things for them and all of those things, and now they are talking about additional benefits that we may be giving them, doing a bulk customer permit, so that their electricity price will be about half what it should be. All of these concessions should earn us a better price than they got in the implied deals that in the implied pricing that they gave to Piedmont, in the deals that they made with Piedmont. So that's the argument that we are making around some of these valuation issues. We have huge challenges with MEF in the way that it goes about communicating the so-called benefits. It's not very rigorous. They've said, for instance, that they've already made a gain of about 30-something% just by buying, having the deal, signing the deal to buy at 26 cents, because for a short period of time, the price went up to 34 cents. So they have already logged in some gains. How does that make sense when you thought you've not even paid for the shares? You've not sold the shares to actually know how much you'll have realized as gains. And on top of that, the price of the stock changes all the time. So you have to take a longer term point of view. If you take a longer term point of view, pricing has gone down from a high of about 41 cents to now about 25 cents. So if we are being careful, we will even say that this stock has lost about 40% of its value this year. Is it the kind of stock you want to pay 26 cents for when it's now 25 cents? It could potentially go down more. So it's a long-term play you have to do. And that long-term play for a company this young, which has had this volatility in its stock price, and to do proper strategic management, proper strategic horizon forecasting about the factors that would determine its long-term value. So those factors is what we want to see. We know, for instance, that there's competition in terms of the technologies that are competing to become the standard for electric vehicles. Sodium-ion is doing very well. The Americans gave money to NASA and they did some research. They've now come up with selenium sulfate. There are so many technologies for batteries coming up. Some of them will compete with lithium. Then there is also the fact that lithium has massive advantages in energy density and other factors. Or you have to look at that balance and then create some kind of forecasting model that gives an idea of the likely long-term value of this asset. And that is what you have to convince us has been rigorously done. The second thing is that on top of doing that, you need then to also protect the share. You get it? So if now they say they want 3% in the parent company and 6% in the local company. Okay, fine. We used to have 16.8% in Ashanti Gold because of the history. We used to own it. We used to have like 55%. Mm-hmm. We used to be majority shareholders. And then we privatized and it went overseas, went to the stock exchange, went to international stock exchange. Over time, we came down to 16.8%. Today, we have 0.04%. Why? Because whenever the company goes and raises money, as the company becomes more attractive and it raises money at higher and higher valuation, our stake was diluted down. So what we are asking is, what exactly is MEF's strategy to prevent that from happening? And they claim they have the right to invest in subsequent raises. But we have the right to invest in subsequent raises for Ashanti Gold as well. We just didn't have the money. This is a country that, look at our current circumstances, going to the IMF, it's not going to be possible. So the way other investors do it is to do something we call weighted average or full ratchet rounds, where every time you are raising money again, we adjust the valuation of our existing stake to ensure that you are not diluting us too much. I don't understand why MEF is being hesitant at being clear about that prospect. The evaluation of the asset itself is very questionable because they've given us different numbers at different times. In one of their releases earlier, they said it was $1.4 billion, the way they value the asset. Recently, they say they think it's $691 million. As I've said, all of those assumptions they are using are very hypothetical. What has actually happened is we know Piedmont has used strategic investment strategies to acquire shares. And the pricing that Piedmont has got the shares for is about a third what they are going to get. So the question is, if Piedmont, because of the fact that it gave them money upfront when they needed it the most, could get such a great deal, why are we not using the fact that we're giving them all of these benefits? Like I said, we've expedited their mining lease application. They've been in Ivory Coast all this while. Ivory Coast has not done that. We've done all manner of things for them. So why can't we get a better deal than what is being posed? Also, they have to show us the analysis. They say they've used intrinsic value to measure it. But intrinsic value, when you have a stock this volatile, it requires that you have a margin of safety, right? You don't just because the discounted cash flow that we have from the feasibility study does not take into account, but it's not reflected in sensitivity analysis inside the feasibility study about the changes in pricing going forward. So that discounted cash flow analysis could be completely upended if the price of lithium continues to seesaw. So you need to adjust for historic volatility. And when you adjust for historic volatility, your intrinsic value of the asset, if you take into account the fact that it's very risky, then like every elementary financial analysis, you do a risk adjustment. And that will give you a sense of the true intrinsic value of this asset. And if, of course, the warrants that they want to buy at 36 cents, why would you want to buy at 36 cents? You want to see some kind of Blasco's valuation method that takes into account also the historic volatility. And then it has all the other parameters, and you share this to the public. You don't share things where that sounds like it's a propaganda for a political party, right? It's a sovereign wealth fund. It's a technical organization. We are supposed to trust the things that it says. And so far, the data that has been given to us is not very helpful for independent analysts to come to any view. So our position is that the valuation that MEF has been thrown about is questionable. The gains that they claim to have made is unsupported, and therefore we expect to see much better analysis going forward before Ghana allows them to buy that. And already they've committed to buy, they haven't paid. They want to buy more warrants and the rest. This is really, really, really unhelpful. The other thing is the credibility issue that this company has. This company has gone on record some few years back,
right.
3 years back, to claim a year back, where they claimed that they already had the mining license and all that they needed to go to production, but they didn't have it. Recently, they claim to have a 10-year tax holiday.
And really appreciate that detail that you give in this presentation. On the issue of the tax holidays, and this matters that for you as members of parliament, and let me start with you, don't want to quickly, because it's going to come to parliament for ratification. They cannot be set to be an agreement yet, right, until ratification is done. So, quickly, what are the issues that for you
well, technically,
quickly?
There is an agreement because there's a document that speaks to some agreement. So there is a tentative agreement. But constitutionally, it needs to be ratified before effect is given to it. Mm-hmm. And that is what they will do when they bring it to Parliament. And then, fortunately, we have the opportunity to, interrogate all the various clauses. But let me put it on record. Mm-hmm. This is definitely a very huge improvement on the past natural resource contracts. Very huge improvement on that.
But then again,
we will suggest certain areas where we need to improve upon, particularly the penalties for default and performance guarantees and the local content areas.
Okay.
Those areas we have to look at it. But this is hugely an improved natural resource contract. But that brings us to the realization that we may have to go back and look at past natural resource contracts because some of them are very unconscionable. So, based on unconscionability and not fit for purpose,
issues
and not
will have to be dealt with, indeed.
Not equitable provisions, we can look at them back. But this is a very good beginning. Nevertheless, if it comes and there are certain suggestions we have to make it more viable, we will do so. And let us not also wish away Parliament's very diligent eyes that will apply to the contract.
Lawyer, Martin, no, I'll skip you to Dr. Clement Park.
Yes, Alfred, very, very briefly. I think that the argument is not about exploring and taking advantage of our natural resources. The case is about how best we can exploit that to our benefit. And I agree with those who have said that we need to be cautious in the way we deal with this, given past experiences and looking at the future. Right. So if we have to slow down, to have a lot more broader consultation to factor in what we need to for broad acceptability in the national interest, as has been indicated by senior statesmen and women. I'm not even talking about we the politicians.
Right.
We ought to do so.
Great.
And I think that is what Ghanaians are calling for.
Thank you. Bobby Banson.
Well, Alfred, I think Mr. Bright Simmons has done very justice to the issue at hand. And indeed. What I appreciate is that sometimes when you hear criticism to such policies or such agreements, you don't hear alternate proposals. They merely just want to say it's bad, it's bad, it's bad, without giving alternate proposals. I think when you listen to Mr. Simmons, he does not necessarily say the agreement or the proposed agreement, I'd rather put it that way, subject to ratification of Parliament, is inherently bad. He admits that it may be some form of improvement, but he has highlighted areas where he thinks there could have been further improvement considering the international regime of such transactions. And I hope that if it goes to Parliament, we would have a very extensive discussions by Parliament. And the minister or those that are proposing this agreement should not take, as for lack of a better word, a stubborn stand to say that whatever it is, this is what we must push through. There should be open for discussion so that this agreement will not suffer anything that when there's a change of government or when there's another regime, they will come back and then it will result in judgment debt against the country. So I hope that all these discussions are being taken into consideration by those that propose this document. And when it goes to Parliament, the requisite discussions will go into it. And the amendment, as has been proposed, backed with facts, science, data, as Mr. Simmons has done, will go into it, and then we will take it from there.
Indeed. I thank you so much. Bobby Banson is a private legal practitioner. He's a lecturer at the Ghana School of Law. Lawyer Martin Pebu, I really do appreciate your concession on this. Thank you so much. As also a private legal practitioner, also to you, the Honorable Andia Piakobi, a member of Parliament for the Asante Achim North constituency. And also,
my disappointment is that I thought this was going to be
let me also indeed. It's a continuous one. Yes. Let me bring Dr. Clement Park. Thank you so much for coming. Appreciate you. A member of Parliament for the Bosa South constituency. And on behalf of the team, we appreciate your time. As I indicated last week, this allegation on the Comptroller and Accountant General putting the names of delegates on payroll is not true. And that is what we had to put on record. I am Alfred Okanse. Have a good one.